no rate rise, and I've read the minutes as well, and pretty much the same language is used in previous months, noting a lot of uncertainty for the economy going forward, a slowdown in expenditure. But I note the Reserve Bank of Australia this time also mentioned that there is a small percentage of the community benefiting from rising interest rates and benefiting from the rising housing market.
Okay, so beautiful. By the way, let's wait for this audience to build up. We've got our audience on Facebook, and we now have an audience on Zoom. Let's get these numbers building up. We're up to 87 people here that are watching on the Zoom. And
I'm not sure if you know, Louis, in the middle of his own conference, he needs to leave at, I think you said 4:20, did you say?
I got to leave at 4:25 Sydney time. Yes, we're coming in from Hamilton Island today, and SQM Research is having its conference up here. And I'll be speaking in about 25 minutes at the conference.
Okay, so team, it's 4:02 Sydney time. It's 3:02 Queensland time. We've got Louis Christopher with us till 4:25, which is another 23 minutes. I want to let you know that Louis Christopher is regarded as one of the leading real estate economists, data analysts, forecasters, owners of a data company. Bottom line is, he does the thinking behind real estate, has a crack at thinking what will happen next year, does a bit of a number crunching on what happened this year, produces a wonderful report once a year called the Boom and Bust Report, which came out at the end of last month in November, which you can purchase. I also want to let people know that we're here today because this is our last Tuesday Tech Talk presented to you by Realtair, which we do on a Tuesday once a month. Peter Matthews, who is the president of the Real Estate Institute of New South Wales, was at an REIA board meeting. He wanted to be here as well, Louis, to ask you a few questions as well. But I don't think he's going to be out of his meeting. So, Louis, firstly, you're in Hamilton Island. You've got your own SQM Research. Is this your annual conference?
Well, actually, it's an inaugural one. So essentially, it's more like a working holiday where I've brought up the whole SQM Research team to do some team building, to talk about 2024. It's more of an internal team building conference.
Okay. Susan, in the background, occasionally, if you can put in the chat box and in Facebook, the Realtair link, because they have actually promoted this to their members and community as well. Louis,
and we'll also let everyone know at the end of this, type in the comments what was your key insight, because you're going to have the chance to win a one-on-one coaching session with Tom.
Okay, beautiful. So you get a coaching session, key insight. So Louis, firstly, let's kick it all off and ask you, your Boom Bust Report came out last week in November, which is essentially last week. You actually, I haven't read the report. I'm buying the report myself today because I went on there to do some research on it, and it's right there front and center on your website. You're going to whet our appetite and tell us a little bit about it, but I'm going to kick off. You actually are not as bullish as some of the other real estate economic commentators. You believe that we could have a few challenges next year in the Sydney-Melbourne markets.
That is correct, Tom. So our forecast nationwide is that housing prices are more or less going to flatline depending on the city which you are in. The overall forecast is prices will change somewhere between -1% to +3%. We're most positive on the Brisbane and Perth housing markets, where we think those markets are going to rise somewhere between about 5 to 9%. We're least positive on the Hobart and Canberra markets. We think they're right for a reasonable size correction, but still staying in single digits. And for the two largest markets, Sydney and Melbourne, we're expecting a modest to moderate correction. it's particularly for properties between $1 million to $3.5 million. Essentially, those properties being bought by borrowers. We're expecting a correction. The correction we're expecting is somewhere between 0 to about -5% for those two cities overall.
Okay, so let me summarize. You're feeling strong about Brisbane. You're feeling strong about Perth. You believe Sydney and Melbourne are going to be not great, not bad, but between 0 and 5%. You used the term borrowers. So I presume that you're talking, there's a cohort of people that are non-borrowers. Is that what you mean?
Yes, that's right. So we believe that the top end, the very top end of the Sydney and Melbourne markets actually likely to stay reasonably strong. And I think that some of the economists that you make mention of, I think they're reasonably positive on the top end as well. It's the middle end which we're more concerned about. The primary reason why we are is because we think interest rates are now at the level which are starting to really bite the community. And it's causing an economic slowdown. I think there's now more caution out there. And over and above that, some of the leading indicators we like to follow, and we also publish, such as option clearance rates in Sydney and Melbourne, have been trending downwards essentially since the month of June 2023. Now, in all this, for your seasoned viewers, many people will be well aware that in the spring selling season, there tends to be a bit of an easing in clearance rates due to all the seasonal stock. However, I think what's going on here is a little bit more than seasonal factors. I think what's actually occurring here is a slowdown occurring in the housing market. So at this point in time, this is one of the primary reasons why we're a little bit more negative. Over and above that, everyone's well aware of migration, and it surprised many people why housing prices rise over the course of 2023. What drove that, of course, was very, very strong migration. Well, our view is for next year, migration is actually likely to slow a little. And this is another reason why we're just a little bit more negative on the market than what we were for 2020.
Now, Louis, I'm curious, Adelaide you haven't mentioned. Have you got a view on Adelaide?
Yes, Adelaide, we're a little bit more positive on. The forecast is a price change of somewhere around 0 to about 4%. But, nothing major, nothing like what it's had this year.
Okay, so I find it interesting, Louis, that you're mirroring my anecdotal evidence at a grassroots level. I mean, to give you an example, I've just got off a phone conversation now with an agent. I'm not going to mention his name because his vendors wouldn't probably want me to hear it. He said to me, Tom, I've got a lot of options on the 16th. I've got another client I was speaking to that they told me they've got about 8 options on the 9th of December. I've got other clients telling me they've got options on the 16th, and they've got no buyers. They've got 0 buyers. He said to me, I think what we should do is actually just call these options off, take them off the market, put them back on mid-January as a new listing with a view that there's more sentiment. But I think you're right, Lee. I don't think it's just the seasonal factors of excess stock that's been building up. I actually think that we've got the seasonal, plus we've also got this gradual increase of rates. And I think the last one may have been the tipping point.
I think so too, Simon. You might not recall this, but perhaps some of your viewers would. At this time last year, we were one of the few analysts out there predicting that the market would rise in 2023.
Mm-hmm.
And we seem to have got that right. But there was one caveat that we had with that forecast, and that was that the cash rate, we wouldn't want to see the cash rate go beyond 4%. If it did, then we were starting to become more negative on the housing market once it did that. Well, it's now done that, and we're following through on that. This is one of the reasons why we are a little bit more negative. I think there is an increase in housing stress out there. I think people are cutting back their expenditures. So home, of course, is always the last to go. So we're not expecting massive false selling, but we are expecting a tick up in false selling. More so, the downturn that we believe we'll experience is going to be more driven by a lack of buyers, and particularly borrower buyers, which will either become more cautious as the economy slows down, or there'll just be less qualified buyers out there because employment's slowing, and given where interest rates are, it just means that there'll be buyers who cannot borrow as much money as what they could this time last year.
Because my audience, Louis, fundamentally is real estate agents, some mortgage brokers, and a fair, decent number of investors or followers of real estate. One of the things that they keep saying to me is, but Tom, people are coming over from overseas. You go to Mascot Airport, you go to Tullamarine Airport, there are people flying back into this country. Apparently, I've seen a bit of data suggesting also there are more millionaires migrating to Australia than any other places in the world. That's what I've read as facts. These things here, how does migration impact things like prices and more important, unemployment? I mean, why is Albo saying bring the people in now? And why do you think they're going to say stop bringing the people in?
Oh, well, I think you'd be cautious about saying bring the people in now. I mean, this takes us back to the closing of the borders, the opening of the borders, and the fact we've had a flood of people coming in, which has generally not been well controlled or well managed. The view has been up until recently politically that, okay, this is just simply a bounce back from the period of COVID, and we should allow as many who wish to come here, and that's fine. But what it's done, it's created stresses on our essential services. It's created stresses with our infrastructure, and of course, it's created stresses within the rental market itself, as has been widely reported. There has been, of course, a proportion of migration which has been cash buyers in the housing market, and they will still be there in 2024. Our view, though, is that this surge without immigration, number one, it's an abnormal year, and we'll probably go back to more normal levels in 2024. Whether that's just a normal change or whether that's driven politically, we'll find out, or a bit of both. And second to that, we think the market has priced in this surge in migration to an extent. And so we're not expecting the same surge in terms of a rise in prices with housing and indeed with inflation. So this will be the one good news that I piece of will have. But I think that this time next year, we'll be talking about inflation coming back to about the 3% mark. And in all this, we're not forecasting a crash. Indeed, it's quite likely this will be a one-year wonder except for the downturn. The RBA has now ammunition to cut interest rates. Okay? So if we do have the economic slowdown, it should mean inflation will slow as well. And I suspect this time next year, we'll get an interest rate cut.
Oh, wow. So Louis, you have a view that... do you have a view that rates are going to keep going up next year?
It's possible if the issues, or not issues, but a stronger word, the events within the Middle East continue to get out of hand. I'm not sure if you're aware, but in the last 24 to 48 hours, there's been some merchant ships attacked, basically off the coast of Iran. And that has the potential to see oil prices skyrocket. If that does happen, then you'd see a second round of inflation, very similar to what happened in the 1970s. That is a clear and present danger to the economy, not just the domestic economy, the global economy. And if that scenario were to play out, and we have modeled that for this year's report, then you would see the RBA being forced to lift rates further. On the other hand, if the Middle East kind of stimulus that doesn't get further out of control, we shouldn't see inflation come back to normal levels. Indeed, we're starting to see in other countries, inflation starting to become more controlled. And indeed, in our country, this time last year, recall we had inflation reads of up to 8%. It's now coming in below 5%. So it's heading in the right direction. And if it keeps heading in the right direction, I think it will, you will likely see an interest rate cut by this time next year.
You mentioned early on in this conversation about some of the extra comments the Reserve Bank gave along with their rate pause, and said that there's a view that some people are actually quite happy about rates going up and gone to this level. Tell us more about that.
Yeah, the RBA has put in some extra wording in this. Excuse me. Sorry. They've talked about savers. They've talked about people who are actually better off with rising interest rates. So they're referring to savers and people who are buying homes with cash. And it's interesting they make a note of that. They haven't made a note of that recently. And they're suggesting, okay, fundamentally, they're trying to give an explanation as to why housing prices rose in 2023. And essentially, they're saying that there's been an element of the community that's done better with rising interest rates and has done very well, thank you very much, for the ongoing strong economy. And they put that as one of the reasons, in my view, as to why housing prices lifted in 2023. Now, I think there's some truth in that, but they have failed to mention migration, which they have in the past, but for whatever reason, they didn't do that in this statement.
Okay, so during last week, the Reserve Bank boss was at a conference overseas, and she's been quoted to have said, look, Australian households are doing pretty good regardless. And she went on to then say, and I've got to tell you, that may or may not be true for some households. I find it interesting, you know, Louis. I'm a freelance auctioneer on Saturdays, and I can go to an area and auction a property for $5 million, and then I go to an area and I auction it for $500,000, and I see two different worlds, right? What I see is a buyer easily go from 4.5, 4.8, 4.9, 5, yep, deal done. And then I'll be out in Minto and they'll say 851 or 51,500 or 852. Then I'll go up to the buyer. You get a bid anymore? I can't. They've reduced my borrowing capacity. That's the maximum I can go to. Lots of those stories, Louis.
Yes.
A lot of stories where they say to me, had I bought 6 months ago, I could have bought something dearer. They won't give me the money anymore, you know? Obviously,
that has been going on. That's definitely been going on, Tom. I've seen it too. But for the top end, you senior executives of companies, your small to mid-sized business owners who are doing very well, thank you very much, with the current economy, they've got endless cash. It always feels like they've got endless cash. And this is one of the reasons why we think that that element of the economy will still be there in 2024, and hence the reason why we're more positive on the top end of the marketplace. I still think it's going to run. One caveat to that is that if we go into an economic recession, I guarantee you those small to medium-sized business owners are going to be hurt the most. And they will no longer be there in the market.
Yeah. So, Louis, obviously, these wealthy cohort group executives, what have you, those that have got money in the bank, surely they must be part of the inflation issue that we have. Because if you've got money, you buy cars, you travel, you eat at restaurants, you go to a hairdresser that charges you $150, not $15, right?
Absolutely, and that is true. And the RBA has reported on this. So they report on overall savings with the economy. And they've pointed out that over the past year, we've been drawing down on our savings. So I think you'll find that, you know, when we look back at over the COVID period, if most of the community did remarkably well. there was a lot of stimulus in the economy and a lot of people saved that stimulus. Well, now they've been using that stimulus despite rising interest rates. They still wish to keep their standard of living going. So they've still been going to the restaurants. They've still been buying houses. But the issue is we've burnt through a lot of those savings now. What we had in the kitty at the start of this year is no longer there for many people. And this is one of the key reasons why we're now seeing a slowdown in retail spending. You'll see, for example, Harvey Norman reporting a big slowdown in their retail spending. The overall numbers from the Australian Bureau of Statistics now recording a negative retail spend. That's dangerous for the economy. When you normally see negative retail spends coming through, if that comes in, month out, that normally spells recession.
Yeah. Well, Louis, again, you've been very, very thorough. You put your neck on the line. You have a go. No one ever gets it 100% right. You've got a decent track record, but versus many of the other companies and forecasters. In summary, what you're saying is keep a lookout on those developments overnight happening in Iran with fuel prices. That's a potential impactor, correct?
That is. And Tom, if we're going to be wrong next year, where we're going to be fundamentally wrong is that the economy doesn't slow down as much as expected, or migration runs harder than what we expect. If we have another year of some circa expansion of 600,000 people or more, we'll be wrong. We'll be wrong on the upside. The housing market will do better than what we expect. But we do expect migration to slow down a little. I think it's going to be a major political football as we lead up to the election year. And I think the federal government will be doing more to try and slow it down. But I also believe we'll see a natural slowdown. I think we're going to see more students, international students, finish up the degree and leave, less arrive next year. And that will help somewhat with the rental market, notwithstanding the fact we're still going to have a shortage of property in 2024.
Yeah, but I have noticed another thing is, Louis, during the COVID periods, particularly the scary periods around that lockdown, there was a lot of people that moved into single households. And that took a lot of property up, Louis, because just picture one person to a one-bedroom or two-bedroom property. And that took a lot of properties out of the market. I've noticed in recent times we're moving back to more people sharing accommodation, which is a big thing. You got any comments on that?
Yes, we have. I think your observation is correct, Tom. The reason, of course, why we had less people per property is because people were wishing during COVID to get away from other people, to get away from the lockdown, so they were moving into regional Australia. There's been a reversal of that in part this year, where due to skyrocketing rents, younger people in particular have been sharing more in our view. That will persist, I think, more in 2024, but we're not forecasting a fall in rents next year. That is because it looks like, based on the ABS data, we're going to build less next year than what we did this year. Building approvals have been falling away because of the rise in interest rates. And this is really going to hurt, I think, the federal Labor government, who have promised to build 1.2 million dwellings over the next 5 years. Well, I can tell you for year one, they're going to be about 100,000 short of what they need to build for that year, which is 240,000. We're going to build somewhere around 140 to 153,000 dwellings.
Louis, I had an auction in Punchbowl on Saturday. A DA approved 2 houses that can build 17 units. These are the sorts of things under 3 million, like 2.7 million. These are the things I used to get 10 or 15 builders rock up in their Range Rovers, their work boots, bidding away. There was not one person there. And then I looked at one guy across the road who I'd seen at other auctions. I said, "You're not going to have a go?" And he said, "Are you for real? Why would I have a go when materials have gone up 40%, our profit margin is 20%, we've got a building commissioner that won't let us go, we've got a government that makes it very, very hard." He goes, "No." He goes, "I'm not going to be bidding, and I don't care at what price it is. It's just too risky." And I'm just thinking to myself, there's a lot of people thinking that way. They're not rebuilding any properties. If they were to continue with this migration, we have got a serious demand and supply issue on rental accommodation.
We already have one, as you know, Tom. When you're recording rental vacancy rates of 1%, we've been there now for the last 12 months. it's tough. And over and above that, Tom, I'm sure you're well aware of this too, is that there's been more and more properties go to the short-term leasing market. I put a big chart on Twitter about that the other week, got a lot of attention. Essentially right now, there's been more short-term rental listings than what there is long-term rental listings in the market. That's the national market. Now, people, the knee-jerk solution there is, okay, well, we got to hammer short-term leasing to make it difficult for property owners to do that. Well, no, that's not the answer. What you've got to do is you've got to provide more incentives for landlords to come back into the long-term leasing market. And as you point out, cost of building is sky high. There's been builders that are going backwards, so that doesn't help with confidence for buyers to go and build a home. That's all got to change. The federal government's running out of time to do this.
Okay, Louis, you're going to head off now. I know you've got to do a presentation in around 5 minutes. The Boom Bust Report, $59.95. How many pages is it, Louis? Is it a decent document?
This year it's 135 pages.
Okay.
So that covers all the postcodes. So we talk about the cities, but what we do in the report is we get into the postcodes. We provide a lot of quantitative data surrounding the postcodes. We do risk ratings on the postcodes for the year ahead. So it's a lot of information on the postcodes. Half of the report essentially is on the postcodes.
So and this is for the January-December calendar forecast. The Boom Bust Report. You do a deep dive by postcode. And what are you looking? You also put a rating on whether you think a place is safe or not to buy.
Locality. So we do a risk rating in the locality. So that takes into account interest rate sensitivities for that area, what population's been doing in that area, what incomes are doing in that area, how much stock is on the market in that area, what rents have been doing, what the rental vacancy rate. So we take all that into account and we essentially issue a rating in that area, which is a scale rating that gives you an understanding of that locality relative to all other localities in Australia.
Okay, Susan,
we go pretty hardcore with it.
Susan, if you don't mind, would you be kind enough to put in the chat box the actual link for SQM, because Louis taken time off his annual conference / break on beautiful Hamilton.
Working holiday, Tom. Working holiday.
And what I want to do is I want to make sure that people that want to actually get more, I actually find for $59 to be able to have this data, and my job is irreplaceable. Louis, I want to thank you so much. You've heard it here, Louis Christopher from SQM, the Boom Bust Report, his views on 2024. And thank you. Enjoy the rest of your time at Hamilton.
Thank you, Tom. Thank you to your audience. Hopefully they got something out of that, and we'll speak again next year.
Thank you, Louis. Stay well.
Thank you.